Thank you. A warm welcome to you all this evening. I would like to acknowledge everyone in the council chamber this evening, including members, officers, press, and the public. Before we begin the meeting, there are a few housekeeping items I need to cover. Firstly, I need to advise you all that this is a meeting held in public, which will be live streamed for public viewing, and a record of the decision published the following day. The press and public are welcome to attend. However, they will be asked to leave when we have to consider exempt information at agenda number 11 to 16. Exempt information will be considered in a closed session and will not be streamed online. I would also like to remind all committee members that you are required to attend in person. For any councillors who are accessing this meeting remotely, I must remind you that you are not counted as being present for the purpose of Local Government Act 1972, and you may not vote on any item under consideration. You may, however, at my discretion as chair, contribute to the discussion and participate in a non-decision-making capacity. I now turn to the published agenda item 1. Apology for absence. I've received from Councillor Radbourne and Councillor Ayers. Any other apologies? I think the members having, yes, any other apologies? No?
Councillor Gordon.
Oh, Councillor Gordon is online. So anyway, do member have any interest they wish to declare? Declaration of interest? Anybody? No? Agenda item 3, there's no unrestricted urgent business. Agenda item 4, this agenda contains exempt item 12 and 17, and no representation with regard to this have been received. Agenda item 5, no petitions, question, or deputation have been received. Before we proceed to question without notice, I would like to ask the head of pension, Michael Onisset, to respond to the recent announcement made by London Borough of Waltham Forest Pension Fund in relation to divesting their pension fund from companies involving in the armed trade. Michael, thank you.
Thank you, Chair. Yeah, the recent statement by the Chair of Waltham Forest Pension Fund basically states that they are currently preparing an updated investment strategy to be taken to the Pensions Committee, their Pensions Committee in September. Specifically, that statement states that the fund is updating its ethical investment policy so that they can divest their pension fund from companies involved in the arms trade. The statement acknowledges that this is a complex task that will take some time. Obviously, at this stage, it's not possible for us to comment on the nature of any changes to or the content of Waltham Forest Pension Fund updated investment strategy relating to the arms trade. We will, of course, however, review it once it's been published. Alongside that one, there's been various talk of what East Sussex Pension Fund did a while ago. They recently also issued a statement on the changes it made to its investment strategy. And that statement stated that whilst they continue to be supportive of the work of LAC position on the occupied territories, which seeks to encourage companies operating in that jurisdiction to review and have regard to the human rights of all individuals with whom they interact. However, they also state that their investment decisions made in late 2020 and early 2021 have moved the fund's equity holdings to investments that have exclusion policies and indexes aligned to some opportunities around the climate challenge, resource efficiency, and to exclude UN compact violators. On our own front, in the meantime, Hackney Councils has sought updated legal opinion on its fiduciary duty and the ability to divest from specific assets for reasons other than financial. The first iteration of this advice confirms that the Pension Fund's current view of the Law Commission guidance on these issues is as previously set out and understood. I think today we've just received an updated version of that, which again substantiates that view. As you know, the fund is continuing to review ongoing developments in the area and any potential impact on its responsible investment policy. And it's also currently working on a scheme member survey in order to seek their views on a range of responsible investment issues.
Thank you, Michael. Any question on that? Anybody? Any question on that to Michael? Yes, Councillor Chapman.
Thank you. That's very helpful. I just think it could. Obviously, we've had lots of considerations about our investment policy over the years, our responsible investment policy. I remember some years back we had a workshop session, didn't we, with Karen Shackleton, and you know, and lots of considerations since. I'm just wondering where do we see all this coming together in terms of? I'm assuming we're aiming to have some sort of a responsible investment policy or statement that will be related to or incorporated in the investment strategy statement. Well, we do to some extent already, don't we? Just, you know, with lots of pressures and questions put on us. So it's an issue of how we, you know, formally sort of resolve these things, I suppose, isn't it? Just want the officer comment about how we might take that forward.
Sorry, I mean, the current investment strategy does obviously include the fund's responsible investment policy as a specific section in there, which sets out the fund's policy on responsible investment. Obviously, we're continuing to work on that, and we'll look at the results of the survey when that goes out, and through the working group, continue to look at other areas of that policy. But it all comes together in the investment strategy as it does now.
Thank you, Michael. Councillor Gordon, I can see you.
Yeah, thanks, Michael. At our last meeting, in terms of the member survey, you indicated that that's likely to be ready for the September meeting. I just wanted to make sure that's still the case, and also what opportunities there will be really for, you know, for members to feed into the questions. Yeah, and you know, and how much sort of work's being done on that, so we can, you know, sort of establish the views of the membership. I mean, there's obviously a lot of, you know, there's been a lot of interest really on the statement, you know, as Councillor Chapman said, from and you acknowledged from Waltham Forest. So, I mean, and I don't know whether that's going to, you know, I think there'll be similar discussions in other pension funds across London. I don't know whether there is any, you've had any sort of discussions, you know, with other pension funds across London in relation to their response to Waltham Forest statement, and you know, what, you know, I understand we've got to take our own advice, but, you know, just where you see, you know, where the pension fund's moving in this.
So regarding your first point on the member survey, I'm currently working on that. I'm using some previous surveys that other authorities have done as a starting point, if you like, and then building that up to make sure it fits what we see as what the committee want to get out of it. That will come to September committee, but and then we can finalise it to go out to scheme members in October. So that was the timeline, and that's where we're aiming on that one. In terms of engagement with other authorities around the Waltham Forest statement, I haven't had any, to be honest. My own view is, until we see the actual investment strategy and what changes have been made, I'm not sure what else we can do on it at this stage.
Thank you, Michael. So if I may just bring this to conclusion. Yes. You got a question?
Yeah, but first thing, I mean, what Councillor Gordon just said has triggered something. I mean, if something triggers from the what's it called, the members survey, and what will be the justification between the responsible investment strategy and ethical kind of the issues is investment. What would be, what if something trigger in terms of like the satisfaction of members that doesn't go in line with your responsible kind of investment based on ethical business, a kind of investment? What would be your kind of your recommendation to how that can be addressed?
One, I think obviously we need to await the outcome of the survey and analyse what those are. We will then need to look at sheer numbers, I think. Obviously there's 20-odd thousand members across the scheme. So we need to see, hopefully we'll get a good response. But if you, if you only get one from one side of the party and it's quite small, then so that's why I'm trying to be quite, not clever with the questions, but I'm trying to make sure we don't ask leading questions on ones that cover the wider responsible investment remit. Obviously, it will then be for committee to look at the outcome of that survey and decide whether they should or can make any changes to the responsible investment policy based on the views that have come out of it.
Thank you, Michael. If I may say that we've been here before during the 2016 when we set the 50% of divesting from fossil fuel. A lot of people make noise and did not set any measurable target. We were the first one that did that. And not only that, in this time now we've set up what's it called, Responsible Investment Working Group. And we are actually communicating with residents, our scheme members. Now we are thinking of communicating with them. And not only that, we are thinking of actually employing a responsible investment officer to be working with us. So we are not sitting on our hands, not doing anything. We're actually working to make sure that we take account of what is required of us to do, but in a systematic way rather than knee-jerk reaction. So, so thank you very much for that. So I just wanted to go down on record that we are not sitting on our hands. We are doing stuff to make sure that we follow the process and, make sure we carried out our fiduciary duty in a diligent way. Thank you. So I move on to agenda item 6. A member agreed the public minutes of the previous meeting held on the July. Okay, thank you. Is that agreed, everybody? Okay. So moving on to agenda item 7. This is quarterly update report to end of March 2024, page 21 to 94. This report provided an update on performance across the following key areas since the last meeting: governance, funding, and any changes in participating employers, investment, including an update on London CIV, and implementation of the fund's responsible investment policy, and pension administration and communications update. It also provided a committee with information on the position of the fund between January and March 2024. Michael Onisset, could you please introduce the report, please? Thank you.
Okay, so this report, as you said, provides members with an update on the performance of the fund in a number of areas for the quarter ended 31st of March. It's split into its usual sections. So section 6, which starts on page 22 of the agenda, provides an update on a number of general governance issues, including training that's been taken by members and officers, and some updates from the Scheme Advisory Board, which obviously us as officers need to take account of in the work going forward. Section 7, which is on page 25 of the report, shows the funding position of the fund as at 31st of March. Once again, it shows a smaller increase and that the funding level is now at 133%, so it's increased by 3% over the quarter. Although this time it's largely been due to an increase in the asset value rather than further movements in the value of the liabilities, which appear to have stabilised for the time being at least. Section 8 of the report, I'm not going to say much about. I'll hand over in a minute to Sam to pick up the fund manager performance, and he'll take you through the detail of that. Although what I will say is you'll see that it's been a generally positive performance over the quarter, and particularly for the equity portfolios again. This section of the report also deals with, well, it refers to the fund's response to the letter from the DLUHC regarding potential future efficiencies in the LGPS, and I've provided a copy of that response at Appendix 5 for information. As it says in the report, due to the timescales, we were unable to bring that response to committee prior to sending in, but we agreed it through chair and vice chair. Section 9 of the report looks at the usual administration performance from Equiniti. It shows that generally they're continuing to meet the SLA, although performance has dipped slightly compared to the previous year. It also sets out some of the major projects that they've been working on over the last few months. So P60s were all issued in April to members as required. They're continuing the work on annual benefit statements and advising us at the moment that they're on target to meet the regulatory deadline. And ongoing work, particularly around McLeod, obviously. So I'm going to hand over to Sam from Reddington to pick up the performance data from the managers.
Thank you, Michael. So as usual, the way I'll do this is I'll start with the market update portion first. So that's on page 59 of the packs, and make my way through there just to give a bit of context in terms of what we've been seeing in markets and then how that feeds through into the fund performance. So starting on page 60 and thinking about interest rates and inflation and how that's moving markets. In inflation, UK actually for once looking relatively good relative to peers. So CPI down now at the Bank of England's target of 2%, whereas CPI in the US and across the Eurozone is a little bit higher and is now looking at it's kind of plateaued at a level that's still uncomfortably high for those central banks. And probably the most important figure is the US CPI, which today is down at around 3%. On the next slide, just focusing on core CPI, which is seen as a more reliable indicator of the underlying trend of inflation because it strips out some of the more volatile elements of the inflation basket, such as energy and food. This has been falling much more slowly than headline CPI and is still running at an annualized rate of around 3.5% in the US and the UK. And that's quite important because it suggests that inflation will be kind of stickier than central banks would ideally want it to be. And that means on the next page that really the Federal Reserve and the Bank of England just haven't had the level of comfort that they need to begin cutting interest rates. So they've been kept on hold. What they don't want to do is bring interest rates down, stimulate the economy, and therefore push inflation back up. So we're potentially now at a point where that will change. The Bank of England and also the Federal Reserve are meeting this week. So by the end of the week, we'll know whether rates have indeed come down. The US is in a position where they have slightly higher inflation, as I say, but also a much stronger economy. So it's less likely that the US will bring rates down relative to the UK, where the economy is slightly weaker and inflation is slightly lower. On slide 6, this chart is effectively showing how market expectations of interest rates have changed throughout the year. So what they're saying is, what does the market think that the interest rate will be in the UK at the end of 2024? So at the beginning of this year, for example, in January 2024, the market expectation would be that interest rates were at 3.5% by the end of the year. And now that expectation, as you can see, has slowly been rising through the year as these interest rate cuts have not been panning out. And if you look at the most recent number, it's close to 5%, i.e. markets are not expecting more than one cut from where the Bank of England holds rates currently. Moving on to equity markets. So despite the lack of rates cuts, which would be seen as positive for equity markets, they've still had a very, very strong year. and particularly the first quarter, which is what you'll see filtering through into the quarterly report. Global equity markets up around 9 to 10% in the first quarter. So started the year really, really strongly. Since then, they've been ticking up. They've had a couple of bad weeks more recently, but year to date, still up around 12 to 13%. We've seen Japan being a notable outperformer and emerging markets being a notable underperformer, again, which is shown in the quarterly report. On slide 9, so we've had quite robust corporate earnings, which has really helped to support those strong valuations, particularly in the US. Analysts expect equities effectively in all major regions to deliver pretty healthy earnings per share over the next couple of years. And then on slide 10, it's been a particularly actually bad week or bad fortnight for tech stocks, which you might have seen in the news. Tesla missed earnings, and that started a bit of a cycle of sell-off amongst these types of stocks. But nevertheless, the year-to-date story in terms of the equity markets has been one of continued outperformance for these so-called Magnificent Seven, the massive technology-enabled stocks in the US that are really driving the markets. And no stock has really got more media attention than Nvidia. And there's a couple of charts on this slide which show some of the statistics. So despite quite a sharp sell-off, it's still up around 120% over the course of the year. I think it's currently the third largest company rather than the first, because it's kind of jumping around a little bit, but it is a company that's growing extremely fast. And the chart on the right is effectively saying that the company is worth so much money and is so unbelievably profitable that it's effectively worth, in terms of a market cap, over $100 million per employee at the company. Moving on to credit markets. So in credit, looking at slide 12, credit spreads, which is the additional return that you can earn over and above government bonds, have continued to grind lower. That is positive for the performance of those bonds, but negative from a forward-looking perspective, in that we think the performance going forward would be lower. And then it's a similar story as well on the next page in terms of the high yield market. So those lower quality bonds that offer a higher interest rate to compensate for additional credit risk. On slide 14, we are starting to see default rates tick up a little as issuers have to pay this additional borrowing cost as a result of higher interest rates. And the market expectations is that they're going to peak at around kind of 4 to 6%, which is actually relatively modest compared to some of the previous default cycles. If you think about financial crisis, for example, that was kind of double digits in terms of the number of companies that were defaulting. The reason for that is that despite the borrowing costs being reasonably high, actually corporate earnings remain in a very strong position. And so these companies are pretty well insulated and able to absorb those costs. Moving on to the government bond markets. On slide 16, it would be remiss not to have at least 1 or 2 slides on politics. In terms of the impacts that the UK election in particular has had on markets, it's had none. Markets have effectively priced in a Labour comfortable victory, and as a result, there hasn't been a big impact on markets, and actually UK now being seen as something of a beacon of political stability when compared to some of our more volatile peers. On slide 17, this is showing the government bond yields. So as a reminder, it's the government bond yields that are really driving the value of the fund's liabilities through time. We've seen yields continue to rise over the year, which has meant your liabilities have fallen in value. And the reason for that is what we said before in terms of how inflation is behaving, and this kind of narrative of higher interest rates for longer. Same is true on the next page in terms of real yields. So this is the additional return basically you can get over and above inflation for investing in UK government bonds. You can now get around 1.4% above inflation investing in long-term index-linked gilts, whereas a couple of years ago this was negative. And then penultimate slide, number 19, another politics related slide. I should say this was produced before President Biden stepped back from the upcoming election. Despite that, he was still the third most likely president, even before he kind of given up that seat. You'll see in the implied betting odds. But clearly, Donald Trump is in a reasonably strong position. The US election has a much higher propensity to impact markets clearly than the UK election has. Donald Trump in particular is seen as having more aggressive plans and policies in relation to tax cuts, for example, and spending and more protectionist movement, all of which could lead to higher inflation in the US and hence higher interest rates as well. To summarize on slide 21, as I say, interest rates have kind of really been kept on hold, which has been quite a surprise. That has a knock-on impact on the fund in terms of the actuarial side of the equation and the value that is placed on the liabilities. Equity markets have performed exceptionally well. That's meant that the assets of the fund have also done extremely well. And I think in terms of timing, not that we try to time any things, but we've been quite fortunate in terms of some of the decisions that have been made more recently in terms of trimming that equity exposure, for example. Credit spreads are reasonably tight, so we've got quite a lot of diversification there. And then finally, politics, we think, could be an additional source of volatility as we move forward. And I don't think that's going to change as we approach the US election. Pause there for any questions.
Thank you. Any question? Oh, Jonathan?
Thank you, Chair. Sam, thank you very much. Just to give me a better understanding, when we talk about NVIDIA, it's a fastball question. Would you have an idea of what the forward PE is on NVIDIA for the next year? Are we talking about 70 or are we talking about 50 or?
Yeah, I think it's even higher than that, actually. I think we're Jill and I just discussing that, it's something even closer to 100 potentially.
Thank you. That is astonishing. But I know that they are the Magnificent Seven. But if all seven are like that, you know, high PEs, it's just incredible.
It certainly is something that I guess you can kind of look at it from different ways. With NVIDIA's, from NVIDIA's point of view, the rise in their stock price has been unbelievable, but so is the rise in their profits, so is the rise in their earnings per share, so is the rise in their revenue. And if the AI hype and the implications that might mean for that company continue or even accelerate, potentially that company is reasonably priced or even underpriced. So I guess there's always kind of two ways to think about it. From the fund's point of view, it's a case of, do your equity managers hold this stock because it's been performing so well? And for those that don't, clearly there's going to be an impact on their relative performance.
Councillor Gordon?
Thanks, Chair. Just going back probably to the first section, really. Just to have I've got a couple of questions. Firstly, about the profile of scheme members, because I've noticed that the active scheme members have got an average age of 53, and just really sort of general question about whether there's a high which I don't think is the average age of a worker in the the areas which the scheme covers. I just wonder whether there's a sort of a high opt-out rate with younger workers, and whether that's going to be something that's going to be a matter of concern, because obviously we do need scheme members to fund us going forwards. And my second question is really on I think it's slide 8 in the second pack, the manager performance report, in relation to the LSIV pooled funds, because obviously the LSIV Sustainable Equity Fund has performed over 3 years. It looks like very well, and congratulations on the overall performance, obviously. But the first two funds on the 3-year figures seem to have underperformed at -2.1% and -4.9%. Just wondered whether you had any sort of comments on them, and also the sort of you could tell us a little bit more about the the possibilities in relation to any changes to these pooled funds, and and when those when those sort of things can happen.
I'll pick up the first question around average agent opt-outs, which I couldn't find actually. Oh, Jack has found it. Check out, see. Yeah, yeah. To be honest with you, I think we need to do some more investigation to be able to answer your question on that one. So if you don't mind, I'll get back to you with a response. I don't know what the opt-out rates are and across different age groups, so you need to do
Yeah.
some. Yep.
Yeah, I don't know whether any, I mean, the member surveys have got a particular purpose, but I don't know whether it's going to do any other profiling of members and those sort of general questions.
So what, the age of members, does it come in?
Well, I mean, yeah.
There'll certainly be a factor in like the valuation of the fund at the triennial valuation. That looks
Yeah.
at average age and obviously potential life, post pensions, etc. I'll try and find out some things around the opt-outs, etc.
My second question was around the LSIV funds and their different rates of performance and.
Can you pick that one up, Sam?
Mm.
Yes, so on the LSIV funds, and particularly you're seeing quite high divergences in relation to those equity funds that you're referring to. So I'm looking at this since inception return figures on page 8 of that page. So particularly that first fund, the Global Alpha, has had quite material underperformance, but also we've kind of seen it across the board. I would say with those active funds, with Global Alpha, for example, that's a strategy that allocates specifically to very kind of high growth stocks. That was a strategy that had massive amounts of excess returns over, for example, 2021 and before, but actually over the last couple of years has underperformed relative to a traditional kind of market cap benchmark, which is what the comparator is in our reports. So LSIV can go into this in a little bit more detail when we see them later, but effectively has been a fund which has underperformed quite markedly. In that case, it's quite style specific. In relation to the sustainable equity fund, again, over recent years, and these aren't particularly long-term holdings, but over more recent years, actually the kind of non-ESG or kind of more energy-heavy strategies have outperformed ones that have a lower carbon footprint on the basis that energy stocks have had a particularly strong few years as a result of the higher oil prices. So it's been a particularly unfortunate, I think, couple of years from a style perspective on both of those funds. Yeah, I don't know if you want to add anything to Jill.
No, I mean, I think if you look at sustainable equity funds across the board, they have all been impacted. So it isn't just a case of the LSIV funds, although I think there have been one or two particular issues with those funds. In terms of the manager selection piece, as these are single manager sub-funds run by LSIV, and unless they saw significant withdrawals from the fund by other local authority, they are unlikely to close them or change the manager. In fact, I'm not sure there's the capacity or the ability to change the manager because it's a single manager sub-fund. Where you have blended managers, then you can change one of the managers. So.
Councillor Adebayo.
Thank you. I'm just going back to page 31, in which pension increase was being mentioned. Just would like to know what percentage is the increase? Yes, page 31. What percentage is the increase?
Henry. Henry, are you online? Anyway, while we're waiting, okay.
Can you hear me? Hello?
We can hear you, yes.
Oh, yeah. Now, I got a question on the Hymans-Robertson report. I'm just wondering if either they or Reddington's could answer my question. It's on page 40. The discount rate between March 22 and March 24 has gone up from 4.3 to 6.2%. And I was just curious to know, do we try and average that, or what does the percentage difference make to liabilities? Because in my world, in insurance, when we're reserving for future liabilities, the discount rate makes an enormous difference. And a 2% jump, I think, makes our liabilities much lower. But I'm just curious to know, what does a 2% jump do to liabilities? And are we trying to average that discount rate over time? I know it's probably geared to the bank rate, but I'm just curious to know how we manage that.
Yeah, I can have a go at that one. Yeah, so this is the discount rate that's applied to the liabilities, and you're absolutely right, Henry. This is what's driving the big fall in the liabilities of the fund. Effectively, the discount rate is based on the return of the assets, and the return on the assets is based on an assumption above government bonds. So when government bonds rise, and the margin above that, even if that stayed the same, the absolute value goes up. So that's why the discount goes up and the liabilities comes down. But I agree with you, it's the most important number probably to look at.
So where do you see that going? Because I guess it's back to the market reports earlier, but I'm just trying to gauge, because it makes a massive difference, I think, to our liabilities.
Yeah, hugely. It's very difficult to say whether what government bond yields are going to do, whether they'll go up or down. All we can say is that I think there's going to continue to be quite a lot of volatility in that market, and as a result, we're going to continue to see quite a lot of funding level volatility. But I mean, that's part of the reason why we've done some of the changes on the investment strategy side.
Yeah. Okay.
To combat that.
No. Okay. That makes sense. Thank you.
Thank you. Quickly, Michael, I just want to ask you about the cyber induction for the new members. I know we had it some times ago. I don't know. We're going to repeat that for the new members. Cyber induction. So, if you look at the report, we talk about this cyber security and the vulnerability, the risk of cyber security, being one of the oldest one, apart from Councillor Chapman. We've had a cyber induction about the measures being taken to secure the funds in terms of any cyber attack or anything like that. But I'm not sure if the new members, maybe they've had that kind of induction. So I'm just wondering, are we going to have induction for them?
No, indeed. I agree. The members' induction is something we do definitely need to look at, and training overall, actually. It used to be, and I'm not digging that we don't do it anymore, but we used to do, as you know, it at the beginning of the committee meetings to make sure that we had a proper training session provided. But we agreed that we'd hold additional training meetings, of which we've had none so far. We have tried to build in certain amount of training within the agendas with related topics, but it's definitely an area we need to pick up, and as I say, particularly for members that haven't been on the committee for that long. I have got some training slide packs that I can circulate, which certainly set out some of the introductory stuff. But I think we need to look carefully at the ongoing training requirements of members generally.
Thank you. So if there's any further questions,
Thank you, Chair. Yeah, I should preface this by saying that I'm not registered to give investment advice, and investments can go down as well as up. But I think we must note that we're with a funding position which we're now over £2 billion for the first time ever, and a very substantial funding level. And also note the performance of the Sustainable Exit Fund in helping do this. So I think it's a very good position to be in. And I think it's worth noting that and thanking obviously our officers and advisors for the help getting there. But remembering my preface at the beginning, but it's a good, important landmark for the fund.
Thank you. Very good point. So the officers can give themselves a pat on the back. A good job. Done. Right. If there's no more further questions, and the committee consider the recommendation to know this report. So agenda item 8, high-level monitoring report to the end of March 2024, page 95 to 124. We've only got 20 minutes for this one. So the report is a high-level update on the key strategic pension fund matter, including progress against the business plan, strategic objectives, scorecard, and risk register. It also includes breaches of the law. It provides the committee with latest information on the position of the fund at the end of 2024. It should be noted that some of the information in this report has already been considered by the committee, as this report is being used to align reporting period crossing the monitoring report. Please, Michael, can you introduce the report, please? Thank you.
Yeah, I'm just going to go through the highlights, if you like, of this report. As usual, it provides members with updates on progress of work against the business plan, the current state of affairs regarding objective scorecard, along with details of the risk register and, as you said, the breaches. In terms of the business plan update, I think looking forward rather than looking back at what's in there is one of the main areas I think we need to now look at going forward is our compliance with the Pensions Regulator Single Code. And I'm planning to bring an update to September committee on that, and I'll be talking to Susan about that pretty soon. The code is in force. It came into force at the end of March 24. And I think certainly as a starter, we need to look at the high-level gap analysis as we used to against the various codes of practice that were in place before this one. Obviously, that would identify any shortcomings or weaker areas that we need to improve on. On the fund investment, I think, as you know, we've obviously had regular updates at all the committees. We're pretty much on target to complete the work agreed regarding the implementation of the strategic asset reviews. Two of the latter papers this evening are obviously looking at some of those, the main outstanding areas, those being the impact property and the nature-based solutions. In respect to admin and comms, I mean, most of the information on that was already in the admin report that we've looked at, but this also looks at areas such as McLeod, the ABSs, and points out there's been lots of work required in those particular areas on McLeod, and obviously at this time of year, ABSs, and alongside there's quite a big exercise in redundancy estimates for the schools, etc. In terms of the risk registers, they remain unchanged. The highest risk remain unchanged. There's been some movement and update within the risk register overall, but the highest risk remain unchanged as set out in the report. Finally, the report looks at the breaches register in section 9. I'm pleased to say there's been no new breaches to report. We've still got 2 unresolved. They're both in respect of ongoing late payment of contributions by employers, and we're working to resolve those with the relevant employers.
Thank you. Any questions on this one? Henry?
Yeah, no, I just had a question on page 118 regarding risk number 7, McLeod. I sit on a pensions board elsewhere, and we're beginning to now to roll McLeod into becoming almost business as usual, because I think what's the issue is now being clarified. It's now just a question of getting on and changing all the relevant entitlements. I'm just really just wondering, when do officers think that the McLeod remedy or putting our books right is going to become more of business as usual rather than what is currently a red risk?
The main reason it was a red risk was because we was waiting for the final regulations to come out around the remedy. They are now out, so obviously the project is looking at those to make sure they're put in place properly. In terms of business as usual, the team at Equinity are already, they've basically got most of the data for most employers. There's a little bit outstanding for some of the smaller employers. But they are already identifying cases where the remedy is required to be used, and also the only other areas at the moment that's quite a manual process because of the older system we're on. So the whole issue around getting that into an automated process is going to be linked into potential upgrade to that system, which is also linked into some of the paper later on. So I'll discuss at that point. But we are moving towards business as usual, and that project is generally going quite well. It's going very well, actually. I think the delays have been mainly around the regulations coming out.
Okay, that's very kind.
Okay.
Thank you.
Any other questions? Okay. Just a quick one from me to follow on about the McLeod. Are we on target to meet the regulatory requirement?
Yeah, I think as I just said, so we have still got it as a red risk. That's because of the issues I've just set out. The project is well advanced. It's already being used by the administrators, and we've captured the scheme members are actually affected by it. So yeah, we are pretty much on target to make sure that remedy is in place and we're administering it effectively.
Thank you. If there's no further questions, then can the committee agree the recommendation to consider and note the progress against 1 minute, let me finish. The progress against the business plan, task and action and agreed budget, the current measures on the strategic objective scorecard, the risk register and the risk identified, the breaches register. Do we agree on that?
No.
Thank you. Noted. Noted, yes. Yeah, consider and noted. Yeah, thank you. Thank you. Right, agenda item 9. This report is for decision. Small Employers Administration Policy, page 125 to 138. So we've got 10 minutes for this. This report is seeking the final approval of the Small Employers Admission Policy, which was considered by committee at its meeting in November 2023. The draft policy was then sent to all employers in the fund for comments, and none were received. The final policy is therefore the same as was set out at November 2023 committee. The policy outlines the admission process for these small employers and set out how contribution rates are to be calculated and how risks are shared under the proposed pass-through arrangement. Michael, please, could you introduce this item? Thank you.
Yeah, I'm not going to spend a long time on this one because, as you've already said, this policy was approved back in November by the committee. It's only been brought back, so it was approved subject to employer consultation. We carried out that consultation with all employers in the fund, had no comments back from them. So we're just bringing, it's basic, unless there's any questions around it, it's rubber stamping what you've already approved back in November so that we can actually put it into practice going forward.
Thank you. Any questions on that? We've seen it before, but if there's any questions or anything, is that? Sorry? No. Somebody's put up one. It's our hands, I don't know.
Councillor Gordon.
Councillor Gordon?
Thank you. Yeah, I'm sorry, I appreciate it's been to the committee before, but can I just clarify how often we expect to use this? Because I mean, obviously the council's general policies in relation to to insourcing, and this is, yeah, in relation to situations going in the opposite direction.
Yeah, I think we expect to use this less and less. So as the small, as we do insource things, but of course the schools can still most of these small contracts really come through the schools, cleaners and school meals and things like that. So if they insource, then obviously we won't get too many more from there, but we're certainly not expecting many more employers back through the council due to its insourcing policy. So I'd expect the number to reduce. I can't say that for sure, but I'd certainly expect that to be the case.
Thank you, that's reassuring. Yeah.
Okay. Any other questions? So, Michael, I just want to ask you about the impact of this agenda item in terms of exit credit. Because this is kind of passed through. So the exit credit, how does it work with that in this regard?
So because on the pass-through arrangement, I mean, it's another reason why the use of this policy would probably reduce anyway. Because of the exit credit policy, if anyone comes through on a pass-through arrangement, then it's the council or the employer that actually picks up any risk. So there is no exit credit or payable at the end of any contract. It would remain with the employing authority.
Thank you. If we don't have any further questions, can the committee consider the recommendation to approve the final small employers admissions policy? Approved. Yeah, thank you. So agenda item 10, exclusion of the press and public proposed resolution that the press and public be excluded from the proceedings of the pension committee meeting during consideration of exempt item 11 to 16 on the agenda on the grounds that it is likely, in the view of nature of the business to be transacted, that were members of the public to be present, there will be disclosure of exempt information as defined in the paragraph 3 of part 1 of Schedule 12A of the Local Government Act 1972. Thank you. Can we stop the stream? Streaming? Thank you.